Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. Known him for years now. He's a good friend. He's been a hedge fund manager for many years at Baring Asset Management. He was featured in a Barron's article about his calls on the 2008 financial crisis. He was shorting a lot of the mortgage-backed securities and the bank shares. He's also bought a lot of undervalued stocks over the years too. As a hedge fund manager, you're long, you're short. If you're a correct hedge fund manager, unlike the current trend traders and a lot of the guys that just copy trades. For our retail investors out there, he also in the last 2 years launched a retail investment newsletter with a model portfolio called the Coffee Can Portfolio. Kevin Duffy, thank you for joining me again.
Hey, Jason, thanks for having me back.
So, Kevin, we're recording this interview on Thursday, September 5th, 2024. Gold prices are substantially over 2,500. Seems like every time they dip below 2,500, a bid comes in and starts to buy them. Maybe it's out of Asia with retail demand or central banks. And then the 10-year U.S. Treasury yield, it's dove down. It's been a roller coaster the last 9 to 12 months, but now it's substantially down a lot in the last couple of months. It's down a little bit above 3.7% when we're recording this interview. I want to get your thoughts on the Austrian theory of the business cycle right now with the central bankers, the Federal Reserve Bank, these PhD economists, almost 15 years of zero interest rate policy, the quantitative easing programs. Then in 2021 and 2022, they raised interest rates at the fastest pace in history. They keep rates high. Now they're talking about cutting rates. What do you think all these distortions and these PhD economists doing lever pulling with the interest rates, what type of distortions do you think they do to the real economy and to asset markets?
They do tremendous distortions. First of all, they create a tremendous amount of moral hazard. I think that's probably at the top of the list. But yeah, the Austrian theory of the business cycle is that interest rates should be set by the market, and if they're artificially suppressed, you're going to get misallocations of resources, and you're going to get asset bubbles and all kinds of problems. And you look at what happened. Typically, there's some kind of a crisis or a perceived crisis. I know you had Jesse Felder on a couple months ago when he talked about Y2K and the Fed lowered interest rates, and that kind of gave the bubble there the last hurrah. We had the crisis with COVID in 2020, and of course there were multiple interventions, but so we can't just blame this all on the Fed. But the Fed enabled the several rounds of stimulus, which footed to $6 trillion, and so you kind of get this cumulative effect. You get this muscle memory that takes place, and investors when when there are signs of trouble, tend to just kind of stay at the table, and it causes all kinds of misallocations.
Now, in terms of misallocations, I agree that we can't blame the central bankers entirely, but it's both political parties. I mean, it's Republicans and Democrats. The elections are coming up. I think everyone in the DC metro area here is pretty much just focused on the November elections. But the policy ideas that we're hearing suggested, I mean, they're talking about potentially 50-year mortgages if home prices crash. They're talking about 2 trillion. I've seen research reports here from think tanks and others, 2 trillion to 10 trillion more in military defense spending for Cold War 2.0 to compete against Russia and China for military technology, and just some of the other programs, whether student loan debt bailouts or subsidizing housing for immigrants. It seems like both political parties don't care. And what would you say that the central bankers then are the enablers of spending out of Congress and the White House?
Yeah, they're absolutely the enablers. And the thing is, there's talk about inflation, and of course that's a long subject. And from an Austrian standpoint, inflation is defined as monetary inflation, and that can show up in it can be higher prices of goods and services. It can be higher asset prices. It can cause asset bubbles, which then lead to busts and a deflation in prices. I mean, there can be all kinds of effects of that monetary inflation. But most people, when they talk about inflation, are talking about the effect, and they're talking about higher prices, we are certainly seeing consumers getting squeezed right now. I mean, that is it's really across the board. The dollar stores are the lower income consumer is really getting hit hard. In the middle income consumer, very much getting hit hard. Even the higher end consumer. I looked at a couple of the boating public boating companies, Malibu Boats and Mastercraft, and gross profit in Q2 was down 80% for both of them. Okay, so these are these distortions. You've got these huge booms and now bust. But I think what's going on in Washington is they are intervening in the economy in a number of different ways, and it's causing what I'm referring to as policy inflation. They're intervening in the housing market that makes housing more expensive, especially for young people. You have this desire to onshore or reshore or friendshore, whatever they want to call it. And so, you've got things like the CHIPS Act, and this is causing all kinds of malinvestment to take place. And it's almost comical. You've got Intel, which has been really one of the big recipients of the CHIPS Act money. And you look at what's going on at Intel, and it's just a total disaster. So the government is doing everything it can to drive up costs to consumers. So it's not just the Federal Reserve printing money. And I think this is an important point. You look at the trade war that they're picking with China, another example. All of this drives up costs. So all these things are inflationary, and all these things are hitting really middle America. Of course, fixing this is not on the ballot in November.
Well, I mean, Trump is talking about these tariffs, but that's mercantilism or neo-mercantilism, right? So the trade-off, economics 101, there's a trade-off, right? There's no such thing as perfect policies. We know this from reading Thomas Sowell or other people that are classical liberals or classical economists, that basically if a country tries to put up tariffs to protect its domestic industry, that the consumer is going to have to pay more. So there's no such thing then as free markets if you're getting involved in mercantilism and currency manipulation.
Yeah, well, and I don't even know that it's trade-offs. I mean, when you look at tariffs, who are the beneficiaries? Well, there may be some short-term beneficiaries, and certainly there are companies that might be pushing for higher tariffs. But yes, the consumer, in the long run, everybody is a loser from this. The consumer is the first to feel the effects, but I mean, it's going to show up in lower tax revenues to the government. And ultimately even the winners, they're not going to be propped up by all this. They're just putting off the day of reckoning, really.
Do you think that the Fed rate hikes that have been done the last couple of years, and the Fed keeping rates this high, although it looks like they're almost definitely going to cut for the September meeting, do you think that this has disproportionately hurt Main Street and small businesses compared to, say, large companies, the government?
Well, I think it's kind of, I think this is a little bit backwards, because first of all, I don't think the Fed is raising interest rates. I think interest rates are normalizing despite the Fed doing everything that it can not to raise interest rates. So I think it's just that that market forces that there's this illusion that the Fed is in control. I think this is really at the root of the bubble, the everything bubble, if you want to call it that. Is that we can have this free market economy on the one hand, this great capitalist system in America, and on the other hand, we have a central bureaucracy setting the most important price in capitalism, the interest rate. And so there's been this illusion that that they can pull off this magic trick. And I think what's happening is, as with all bubbles, the when the bubble bursts, the reality starts to set in. And what's happening, I think, is just that market forces are now taking over, and this illusion that the Fed is in control is starting to kind of wither away.
Well, also, you have the large central banks that used to recycle their foreign exchange reserves and trade surpluses. So China, excuse me, China, Japan, Germany, they used to buy a ton of US treasuries and just recycle those for decades post World War II. And now in the last, couple years, especially since those Russia sanctions in early 2022, seems like, especially lately, China and Japan are just large net sellers of treasuries. I know the retail investor in other countries, because the dollar has been stronger and they could get close to a quote unquote risk free, almost 5% yield on a short term US treasury. There's been a lot of foreign retail investors that have parked cash here, but that's not sustainable long term for the spending that DC has planned.
Yeah, this is, I guess you could call it the law of unintended consequences. It also shows how out of touch with reality the politicians are right now. I mean, they think that they can pick a fight with China, and that China's just going to sit there and take it. I mean, no, why would they buy our debt? I mean, they look at what's going on in the United States. They see the circus that is politics. They see how dysfunctional it is. They see the debt, going through the roof. They see higher interest rates, and of course, the government, in their short-sightedness, has not locked in low rates long term, like many companies have. And they're looking at all this, and they're saying, why would we want to invest in government bonds, U.S. government bonds? So it's amazing to me how these people that are supposedly running things in Washington, D.C., don't see what's happening. They don't see what's coming. They're way behind the curve. They are a trailing indicator of everything that goes on. And their days are numbered. I think that's the bottom line, is that there are all these things like the CHIPS Act and the idea that we can prop up dying companies like Intel. These are fantasies, and there's no way that this can continue. And I think that's a good thing. I mean, ultimately, the denouement is going to be a good thing, and I think there's going to be a reality check eventually, even in Washington, D.C.
Well, also with the CHIPS Act, the tens of billions that they're funding for all these semiconductor fabs, and there's 70 of them, over 70, I think, either that are new ones under construction or extensions of ones that are existing to expand those plants over the next 5 to 7 years. So there's a lot of semiconductor, a lot of new supply that could come online and flood the market. So that could cause another bust too.
Yeah, no, I totally agree. There's a lot riding on this. And it's a wild experiment. This is going to be I think, one of the great boondoggles of all time. But I think you're right. We're going to be swimming in supply. So I think that's clearly semiconductors is an area generally to avoid.
But the government has a history of funding these bad projects, right? So if you go back through the last 150 years of U.S. federal government funding a lot of projects, whether it was railroads, canals, many other types of funding projects, I mean, the government, whenever they get involved in these types of things, there's a boom and then a predictable bust.
That's right. That's right. I mean, this goes back, I mean, you could go back to Abraham Lincoln. This is just the latest round of this. Of course, there's much more going on today. We're at debt levels that we've never experienced in peacetime. We've got all that to deal with.
I want to ask you about the banks. Now, you had an amazing prescient call on the banking system problems with the residential real estate market in 2005, 6, 7. You were a little early. I think you talked about in past years, but the trade worked out for you and you were featured in a Barron's article. You netted out really well for that for your fund investors. Do you see similar problems with the banking system now? Are the banks in the US with fractional reserve banking, are they holding a lot of bad loans like commercial real estate, auto loan debt, older U.S. Treasury bonds because the Fed's not cutting rates. Are the banks like their loan book and their assets, are they like toxic at this point?
Yeah, I think that the banks, it's a different set of problems than what we had in the mid 2000s. And this is another example, Jason, I think, of the government trying to promote an idea. If we go back to 2000 and really kind of started with the Clinton administration, it was the idea of promoting home ownership. George W. Bush was really into this as well. And of course, what ends up happening is you have the tech bubble, the dot-com bubble burst. The Fed tries to fight it with lower interest rates. That new liquidity, that new money goes into a new bubble, not the old bubble, the new bubble, and that was what the government happened to be promoting at the time, which was home ownership. All right, so we get a residential real estate bubble, the bubble bursts, and what does the government do instead of just allowing the system to liquidate itself and the bad actors go away, they bail everybody out. And they also go back to the drawing board and they say, hey, they say to the regulators, we need a plan for preventing this thing from happening again. So they craft a plan based on the old problem. They don't consider the possibility that the next crisis might come from a different direction. Okay.
So
And
the
so,
analogy is the general fighting the last battle. So the general looks at the last battle and says, "Oh, I learned all my lessons." And then the enemy comes up with a new attack plan or battle plan, and then the general that thought he had a good battle plan from the last battle is screwed over again.
yeah, exactly. And so this time, last time it was credit risk. This time it was interest rate risk. So, um, the people running things or designing the system could not imagine that the banks would take on a tremendous amount of interest rate risk. Well, as interest rates basically went to practically zero, they got down to almost, I think the 10-year yield got down to almost a 0.5% in 2020, post the COVID response. Um, the First of all, the Fed expanded its balance sheet, right, that we previously talked about. And where did that money go? Went into the banking system. What did the banks do? They basically put it to work. They really, there wasn't much to do in terms of the private economy. So a lot of money went into bonds, basically. So the banks took on a tremendous amount of interest rate risk. They did not hedge that risk, and then when rates went up, they're sitting on considerable losses. So,
Are you
uh,
talking about 2020 during the pandemic? So I think you're talking about
yeah,
that. So for our listeners out there, when people got their stimmy check, they deposit it at their bank, and then the banks have all this cash and reserves. So then the banks are like, okay, we're going to put that money to work. We're going to go buy treasury bonds, like Kevin is saying. So that added, so people depositing their stimmy checks, that caused a lot of problems for the banks because they're flush with all this cash, and it's not just going to sit in cash. They're going to put it to work either on loans, which did not turn out too well if they made commercial real estate or auto loan debt, or they went and bought US Treasuries and then the Fed raises rates and the principal value of the bond falls. When the Fed raises interest rates, the older US Treasury bonds, you get in a situation, I guess, like Silicon Valley Bank.
yeah. So if you looked at, let's just take a hypothetical, because just to illustrate interest rate risk. So if you were to take now mortgage rates, the 30-year mortgage rate got down actually under 3%. If you go from, and I'm not sure, I haven't checked in a while where we are, we're probably at about 6.5%. If you go from 3% on a 30-year to 6%, the net present value of the loan drops by about 40%. Okay. So, when you think about these banks being levered 10 to 1, a 40% hit, even if it's, half of their loan book, is enough to easily take it down. Um,
And I don't
so,
think they're levered 10 to 1 anymore. I think there's like Canadian banks that are levered 15 or 20 to 1. There's European banks that have high leverage ratios. And I think there were American ones that were higher than 10 to 1. I think during the pandemic, Kevin, correct me if I'm wrong, didn't the Fed temporarily Didn't they eliminate the reserve ratio? I think they're talking about doing that in China now too, because Chinese banks are having problems as well.
Yeah, yeah, and so I did an analysis. This was shortly after Silicon Valley Bank blew up, and what I saw was that this was not isolated to Silicon Valley Bank. That the interest rate risk was across the board, and that under a reasonably conservative set of assumptions, the banks, pretty much the entire banking system, is technically insolvent. Now, that's not a complete disaster, but it does tell you, it gives you a sense for how bad things are, and then really it becomes a confidence game. As long as savers keep their money there and they don't panic, then the banks may be able to work their way out of this. And obviously, lower short-term rates are going to buy them a little bit of breathing room, but in order to save the day, I mean, you really need long-term rates, or at least 10-year rates, to go back down somewhere near where they were, at least in 2021. And that doesn't seem possible.
So by confidence game, you mean the U.S. Treasury and the Federal Reserve Bank create a new emergency liquidity program like the BTFP and say it's only temporary, that the banks can draw from that, or the banks borrow from
Well,
FHIB, or Janet Yellen or someone in the White House announces that the FDIC limits are changed from what, 250,000 up to $400,000 or 500,000. So that's part of the confidence game. These rules changes, goalpost moving, accounting tricks.
yeah, absolutely. All the above. Anything to just make sure that that savers are going to keep their money in. I think also kind of interesting that that as long as the stock market is doing okay, as long as the economy is doing so okay, as long as we don't have a recession, a bear market, everybody sort of stays put. But once they get into trouble, and people get laid off, and they're going to have to start tapping into whatever savings they have, then it opens up the possibility of starting to unwind all this, and maybe create some panics at some of these banks. So I don't think we're past the just the major problems with the banks. I think we're set up for something later on. I don't think this is done.
Oh, I agree. They've done the student loan debt bailout, so they bought some time with stuff like that. But you're seeing just a lot of signs of bad auto loan debt, consumer loan debt, credit card debt. So the
Right.
banks have a lot of that. I don't know if the Federal Reserve Bank's going to buy it. They can't write. They start writing it all down in enormous amounts. I mean, then the bank has balance sheet problems if they actually mark to market the losses. That's what a lot of the banks have avoided. They haven't marked to market the losses yet, because then a potential investor like you is going to see this and say the bank needs to go raise capital to fix their balance sheet.
Yeah, that's right. That's the big part of the problem, is that the losses are, as long as they're marked held to maturity, the banks don't have to mark the losses. And I think that's been a big part of the problem.
And we're seeing a lot of evidence that the real economy, especially like for lower middle class or middle class consumers, that the consumer is definitely trading down. So substitution, or they're cutting back in a lot of aspects. So they're focusing on the necessities, and the businesses that were consumer discretionary, whether that was going out to eat or other discretionary items, those businesses are hurting right now because the consumer does not want to use credit card debt and maybe doesn't have excess savings because they're worried about their job, or because of inflation is eating away at their purchasing power and their standard of living. So we're seeing that with the earnings calls for the last, I would say, at least 12 months now.
Oh, at least. And I mean, it's really just across the board. Like I said, it's not just the dollar stores, the lower income, it's middle income, and even I mentioned the boating companies. It's really pretty much, if it has to do with discretionary consumption, it's getting pretty bleak.
Oh yeah, especially for the casual sit down restaurants that are kind of like between I would say $30 to 100 something dollars depending upon how many people eat out at the restaurant. Those restaurants are hurting really really bad. They're closing locations like crazy. A lot of them are close to filing for bankruptcy. I just heard another story the other day that one of my favorite Mexican restaurant chains here, it's headquartered in Texas, but there's a bunch of locations here in Northern Virginia. They have over $30 million in debt and they're talking about restructuring and closing locations down.
Yeah, bankruptcies, corporate bankruptcies up 40% year over year. Um, the savings rate lowest in 17 years. Unemployment rate is ticking up. Um, and yet, the amazing thing is that the economists out there are the probability of a recession. I'm looking at a graph right now where we got a pretty good bear market in 2022, and the probability of a recession, according to a Wall Street Journal survey of economists, went from about 15% to 65%, and now we're down closer to 30%. So it's funny how these economists in their kind of their ivory towers, and of course they're not using the Austrian playbook like you and I are, and I don't think they're really looking at the real world like you and I are. They're looking at GDP statistics, which of course reflect government spending, and that's additive to GDP. And as long as the government spends, the GDP is okay, and they don't seem to be too concerned. So this is part of the reason why the S&P 500 is near all-time highs. Of course, the AI bubble is also a big part of that.
And Murray Rothbard, to add to your points there about GDP, he used to say that government spending should be subtracted from GDP. I know a lot of Keynesian PhD economists in the profession would argue about that, but like there's something called the Keynesian cross, and it counts all government spending, all private sector spending and investment as equal. And in reality, Kevin, we know that that's not the case. That the government is not very efficient at spending a lot of these funds. I think the fiscal 2025 budget projections are over 8 trillion a year in spending. So if the government's going to spend over $8 trillion, I mean, they could pretend there's no recession. That's a lot of spending.
Yeah, no, I agree. I mean, I think you can definitely I think we should subtract government spending. I think if you really get into the GDP statistics, also the way trade is handled, they're looking at, trade deficit is bad, trade surplus is good. I think that's complete nonsense. So that would have to be revised because, of course, trade is mutually beneficial. So the more, the better. And so trade gets isn't being reflected properly. I think even government spending, there are some forms of spending that are worse than others. I think bombing people is probably not a good use of government spending, and maybe building a highway or a bridge is a better way of better use of government spending. So none of this gets reflected in GDP statistics.
Exactly. It's all counted positively. That's the unfortunate point here that the average person doesn't understand about the way GDP is calculated. There's also the deflator here that doesn't even use the CPI rate for the GDP calculations. On top of that, they're counting, like Kevin said, not only like bombs and war making, they're counting like all this ESG bubble here, the energy spending grift. I mean, the return on investment for a lot of these projects, wind, solar, biofuels, electric vehicles, it's either zero if the company goes bankrupt, or it's negative if the company ends up getting a bailout. So I would argue the return on investment for the taxpayer for all these green energy projects is either zero or negative for a lot of them.
Yeah, that's right. That's right. And that's another example of the policy inflation that I was talking about. And, I think what's interesting here is that the bubble, in my mind, the everything bubble peaked in early 2021. And, I remember I actually interviewed Jim Grant, and I asked him about ESG, and he said he called it a bull market luxury. And what we've seen here, and of course, there were huge inflows, right, into these ESG funds. They were all the rage, and you don't see that anymore. You're seeing the pendulum is already starting to swing. So,
Yeah,
I think,
look at BP. The oil company BP, like there's activist investors, value investors that are getting board seats, and they want all the ESG spending stripped from BP because of all the losses on wind, solar,
yeah,
biofuels.
yeah. Remember the very tiny activist that was pressuring ExxonMobil. I forget the name of it. Um,
It was for
uh,
green energy. Yeah, they wanted all oil and gas investment stripped, but Exxon has made a fortune investing what in their Guyana project, their deep water offshore. So Exxon's like a low cost oil producer, but they have like the I would say the best deep water offshore play that's been found in decades. That looks like so they have a lot of growth ahead of them. They're making a lot of money. But yeah, a lot of these oil companies, Kevin, when they start investing in wind solar, the poster child for this is BP because they've been and Royal Dutch Shell, they've been doing this for decades and they haven't made like any profits on their green energy stuff. It's many billions of dollars in losses. I don't know if anyone's calculated the real number.
yeah, yeah. So you have this is the thing is when the government starts getting involved in policy and tries to create incentives, it just results in a misallocation of resources, malinvestment, as the Austrians like to say. And look at look at what's going on with EVs today and the bust there that's taking place. Look at lithium, the lithium producers like Albemarle, and the pricing is just plunged. I think the gross margins at these companies may have gone negative. I mean, there have been some serious busts that have already taken place, and I just think that these are signs of what's to come.
Yeah, I agree about the lithium bubble. I mean, you even had the large diversified base metal miners like Rio Tinto and BHP Billiton. They were buying lithium mines at the top of the market. And I was just scratching my head like, why aren't they looking at buying value? Why aren't they looking at cheap stuff like copper mines or some of these platinum group metal mines, which are running at losses? So you'd think that they would look at buying assets cheap out of favor counter cyclically. They're not. They got involved in the ESG bubble, and I'm sure they're going to be writing off those asset purchases, those acquisitions of those lithium mines soon.
Yeah. And so malinvestment, I mean, that's what's going on. And, the malinvestment can be the government spending money, right? And that's one way. It can be the government basically directing investment through the private sector or misdirecting investment, okay? But it can also be the private sector basically doing it on its own. And I think we're getting an example of that with this kind of gold rush mentality into generative AI. So we kind of it's the hat trick right now. We've got all
It's
three.
even worse than the gold rush because in order to have artificial intelligence, like you have to build all this infrastructure out. You have to have these next generation data centers. And the current data centers we have now for like YouTube and Netflix, Kevin, those require a lot of energy. Well, the next generation data centers, the hyperscaling stuff, we're talking like an order of magnitude more. We're talking we have to build like ones that are enormously much larger, require way more materials like copper, use way more electricity for the artificial intelligence programs. It's absolutely insane.
Yeah. So on the one hand, the government is going to punish the commodity, the energy companies, and the mining companies, and that right. They're going to provide very strong disincentives, and then on the other hand, they're creating these incentives which are going to result in far more demand. Then you're right. Energy, I mean, electricity. I mean, where is that going to come from? And and then on top of that, the utilities are heavily regulated by the government. So it's not like this is some free market corner of the economy that is very laissez-faire and can adapt and react to an increase in demand very easily. Yeah, so it's a fantasy. I mean, this is what it is. It's thinking that they can pull levers and they can turn the dials and direct capital flows wherever they want, and they can turn off. They tried turning off the economy, just completely shutting it down, and then
Also,
flipping the switch back on. And like this is the delusion that takes place in the mind of these politicians and bureaucrats and so-called experts that they can actually do these things, that the economy is able to handle this. And no, I mean, damage gets done, malinvestment takes place. That's what's going on.
The other major issue with government is you also have these policies that contradict each other in like insane amounts of ways. Like you said with artificial intelligence here, I'll use Google as an example. I mean, Google for the last, I don't know, 5 to 7 years was projecting net zero by 2030. They were going to reduce all their carbon footprint, so their energy usage was going to be from cleaner energy. Well, here they are, Kevin. I think in the last 2 years, because of artificial intelligence spending, they've had to do a full 180 on that. And so, like their electricity and energy usage from normal carbon fossil fuels and nuclear power, it's exploded. I think it's increased by 55% in just the last 2 years. So their net zero 2030 plan looking like it's going to be going out the window. Otherwise, Google cannot compete in the next generation data centers and artificial intelligence.
And I think you bring up something interesting, and this is with these, whether we're talking about Mag 7 tech companies or just large companies in general, is that I think what's happened is they have become more and more, as the government has had more influence on the economy, they are somewhat beholden to the government. And so, they can't be independent, and they have to, if the government is promoting a narrative, they jump on the bandwagon. If they're moving in a certain direction, they have to, follow in lockstep. And I think as an investor, obviously we've seen huge inflows go towards the index funds, especially S&P 500 index funds, passive investing, and I think one of the big, there are some risks here that I don't think investors are appreciating, and I think that dependence on the government is a risk. That is a risk that I think you're going to get with these companies, in the S&P 500, especially at the top of the S&P 500. We talked about the infrastructure boom with AI. And one of the things that I remember from your interview with Jesse Felder talking about he said that Google has been basically asset light. Well, now they're spending tens of billions of dollars a year on this infrastructure build.
And Amazon is even higher than that. I think Amazon is buying up land like crazy here in Northern Virginia. Like we're talking, they want to build university-sized campuses of next generation data centers and routinely update them. They've put out projections, Kevin, that they want to spend $150 billion of capital expenditure on these data centers. That's Amazon alone in the next, 5 to 7 years. So that's not even counting Microsoft or Google or Meta, the other big tech companies. NVIDIA will be one of the NVIDIA may have to co-invest in these projects too. So NVIDIA's market cap is so high, they're probably going to have to start putting in tens of billions of dollars or 100 billion here, 100 billion there. They want to get these things funded.
Yeah. And, eventually it adds up to real money. Yeah. Yeah. These it's really incredible what's going on, and I think that these companies they've learned certain lessons, and I think one of the lessons is when one of these tech waves comes along, you absolutely cannot miss it, right? And I think that Microsoft, in 2000, when the internet came along, I think they missed some of these waves, and I think they regretted it. And I think now every CFO that is in Silicon Valley knows that if it doesn't matter whether this AI wave is real or not, or how powerful it is, they know that if they don't invest in it, they're going to get fired. They're going to lose their job. That's the mentality in Silicon Valley right now, is you absolutely cannot miss one of these waves. And so you get this crowding behavior right now, and there's really not a lot of thought to return on invested capital.
Would
It's
you say
just
that this is irrational, similar to what a gold rush, a gold boom type of fever, where people like they only see the finish line there, and they're not thinking that like we have to spend tens of billions of dollars on each data center. How are we going to get the cheap electricity? How are we going to build these data centers and test them out? They're not thinking about any of the important steps that need to get done first.
no, I don't. I think you're right. I don't think they're thinking through that, and I think they are also assuming that the demand will come if they build it. The demand, it's a Say's law, right? That the build the infrastructure, and the internet was a great example of this. And I think the success of the internet may have um, in, enforced um, bad behaviors, or at least um, encourage this kind of crowd type of thinking that we see taking place right now. Because of course, the internet was absolutely real; it was absolutely game changing, and all the rest of it. But even the internet, if you go back, who are the demand beneficiaries of the internet? Well, it was the e-commerce companies like Amazon, it was search like Google, it was social media like Facebook, Meta, it was streaming like Netflix. Okay, but
It improved the just-in-time supply chain inventory too, and allowed for more outsourcing and offshoring because you could do like video chat and phone calls. You could set up your supply chain more efficiently than all over the
mhm,
globe.
yeah, yeah. But the thing is, first of all, those demand beneficiaries in 2000 in the dot-com bubble, okay, there were a lot of players that were vying for, first mover advantage. And that was really the bubble. It wasn't an internet bubble, it was a first mover advantage bubble. Well, the first mover advantage was really just the pioneers taking the arrows in the back. That's really what 2000 was. And so, most of like, let's just take e-commerce as an example, right? The pets.coms and, those types of companies, they all got basically wiped out. And the
Well,
founders ended up living in their parents' basement. But
and I wanted to bring up Amazon too because Amazon shares did crash then, and they were just selling books at the time. But then Jeff Bezos pivoted, right? He started selling other stuff. He survived and adapted, and then the business eventually boomed.
well, yeah, and yes, the stock went down at least 95%. It may have gone down 99% from the high. But he called it Amazon for a reason. He was never in the book business. He always had a vision, and he also his vision was about collecting data on his customers and having an advantage there. And then eventually, so he didn't really pivot away from books, but he did pivot towards the cloud, AWS. And when he did that, it was interesting how the mainstream media uh, poo-pooed the idea. I mean, they thought that this guy was getting away from his knitting and getting into something he didn't know anything about. Well, of course, he knew a lot about it because they had been collecting, reams and reams of data for so long and using it. But it was just interesting how the media missed it, and the media, these business models, the media missed a lot of this stuff. I mean, when Facebook went public, and you have the thumb up that Facebook has. Well, on the cover of Barron's, they had the thumb down, right?
Well,
And
and Facebook crashed after the IPO, but that was a buying opportunity. I think it crashed to like $30 a share, and then it went to $300 or $400 a share within a couple of years. I remember when at my
yeah,
newsletter job back in 2013, Facebook went IPO. I think around 2013, it crashed initially, and I was sitting in the meeting rooms for the newsletter company talking about it was a buy. No one wanted to listen, and then the shares went up over 10x only a couple of years later.
yeah, I don't know. I don't remember it. I'm sure it went down. I'm not sure. I mean, I guess it depends on your definition of a crash. It certainly didn't go down anything like what Amazon.com did.
Oh yeah,
Nothing,
they still
nothing.
because they already Facebook was already making a ton of money in advertising. They already were top two or three in internet advertising because of like the Facebook
They
groups.
Yeah, well, the reason why the media missed it was actually they were just starting when they went public. they were just starting to monetize their user base, and they yeah. So the media total, and this is how I think value investors missed a lot of this stuff. Is that it didn't show up right away in terms of earnings and cash flow. Um, it depended, it depended on the stock. I would say Google. Um, Yeah, Facebook IPO'd in 2012. Google IPO'd in 2004, and Google was at that point they were already. I mean, they still had a long way to go. They were really ramping up their free cash flow, but they were already quite profitable and cash flowing quite a bit. But Facebook, from what I remember, was in the very early stages of that. And I think that's how the media missed it, and a lot of value investors missed it. And I think also, Amazon fits the same bill. Is that they were not reporting much in terms of earnings because they were reinvesting that back in the business, and they were really going for this huge scale business. Bezos had this vision, and he had access to capital, and he used his payables to finance his growth, and he you got to tip your cap. But it was easy to. I mean, I can tell you from experience. I looked at all this, and I saw the future of e-commerce, and it was pretty obvious that Amazon was going to be the big winner. And I passed on it because I had a hard time paying 75 times earnings.
Did
Well,
you see how and why Amazon Prime was created? I mean, it was from an employee suggestion contest. I don't know if the guy came up with the idea, made a lot of money, but basically it was the online version Amazon Prime, the annual fee. It's similar to the Costco membership fee, and that's how Costco makes the overwhelming majority, pretty much all of their free cash flow growth for decades.
yeah, I don't know what I'd have to pull up, yeah, Costco. I mean, that's certainly a big part of their model, but I'm not sure it's quite as big as you say. But yeah, that's interesting. I didn't know that
Well,
about
Costco's
Amazon.
margins are razor thin for a lot of the items in the warehouse. So that's the customer's getting a good deal because Costco's not making enormous margins on most of the items they sell. But where Costco makes their free cash flow is almost entirely on the membership, the
Yeah,
annual fee.
so I'm pulling it up right now, Jason. Give you I can so yeah, Costco is it's amazing because I think Walmart runs gross margins of about 25%. Costco is at half of that. They're at 12.5%. So, but out of their gross profit, membership fees are looks like about 7% of that. Let me hold on a second. No, 15%.
Yeah,
Yeah, about
the margins doesn't surprise me because they've said that they're willing to make less profit on the items they sell as long as their customers are happy. They want to make money on the memberships with the free cash flow growth. So
Yeah,
they're
so yeah, so their membership fee. Let's use probably something that's a little bit more accurate because their membership fee is going to be pure profit. So um, their membership fee as a percentage of their operating income. That's probably a good measure. Yeah, it's 53%. So you're right. It's significant. It's over half their operating income is from membership fees.
Well, I saw like an hour plus long documentary where the former CEO of Costco, I think he's the chairman of the board, he was talking about this. Basically that like they sacrifice their margins so the customers they're not making the margins that other businesses would because they want their customers happy, but the membership fee is where they make it all back.
Yeah, and also it's a scale business. I mean, they know that they can press their advantage by scaling the business, and so this acts. It's marketing. It helps them scale the business faster, and I think this is when you have a scale. I mean, all businesses are scale businesses to a certain extent, um, but some have
I,
real advantages like Amazon, like Costco, and so anything that they can do to get up to scale as rapidly as possible. and it means really rewarding the customers. I mean, that's really what they did, especially at Costco.
I also think they do an excellent job, unlike some other businesses, of actually listening to their customers. So if the customer wants a certain type of product and there's a bunch of customers asking for it, they'll start doing research. They'll look for a good supplier. They'll look for good prices. They'll eventually add it into the warehouse. And then in the case of like Bud Light, right, where the customers were boycotting it, a lot of Costco customers were boycotting it, they remove it from the warehouse. So, I mean, listening to your customers sometimes is a good thing.
Absolutely. Yeah. Unfortunately, I mean, I love Costco, but it's an expensive stock, and I know that it's easy to get into trouble with thinking that a great company is expensive, but in this case, I just can't wrap my head around the valuation.
Oh yeah, I agree at the current valuation, but I mean they've been saying that for the last 15 or 20 years. I was at Investing Daily for my day job as an analyst in 2013 when it was 120 a share and every single other person in the room said it was overpriced then.
Yeah. Yeah. I think. Well, one of the we talked about policy inflation. We talked about the middle class being squeezed. I think that is a long term trend, and so these discounters, they have, I think they have huge barriers to entry. You're not going to see a new discounter show up anytime soon, and so there are, these are really really good businesses, and it's kind of right now. I mean, if you look at a list of all these, it's sort of the haves and the have-nots. Clearly the Costco's and the Walmarts are really really doing well and in favor with investors. But then you look at um, the dollar stores. My God, did you see what happened to Dollar General and Dollar Tree the last week?
No, I
They
haven't, but haven't they been raising prices? Isn't it actually like the $1.25 store now?
Well, they're not raising prices. Well, what they're doing is they're no longer limiting the goods that they carry to a dollar, which is a good thing. I mean, especially I know Dollar Tree did that, and it just means that they can carry more stuff. And obviously, with the inflation going on, there's no way. I mean, what can you sell for a dollar these days? Not a whole lot.
Yeah,
But
even if you do shrinkflation, yeah, I agree. I mean, like the
yeah,
people are going to notice that most of the stuff is empty and the portion drops at a certain point.
and they're getting hit. Speaking of shrink, they're getting hit with, the dollar stores get hit with theft more. I mean, Costco doesn't have to worry about theft. I'm not sure how much Walmart has to worry about that, but the dollar stores a little bit more. But the dollar stores, I mean, they reported. So Dollar General, last week they reported, they lowered their revenue guidance for the year by 1.3%. Stock and their gross margin dropped by about 1%. Stock got hit 32% that day, and it's not like the stock has been, doing all that well. Got
Sounds like
absolutely.
would you think that that's excessive short selling then? So like the shorts are targeting companies like that specifically?
I'm not sure how many shorts are out there, but I would say definitely, yeah, I think an overreaction. So Dollar Tree reported yesterday before the open, and they lowered guidance by 2.4%, and the stock was down 22%, I think. Um, and and they actually saw a gross margin improvement of about 90 basis points. So yeah, I think these stocks are, I mean, really, really left for dead. Five Below is another one that's gotten hit. CEO left, who was highly regarded. He came from Walmart. So yeah, there's some interesting. Like I said, it's kind of the haves and the have-nots. And if you're Costco or your Walmart or TJX, these stocks trade at pretty significant premiums. And then you look at the dollar stores, and they're really just on the garbage heap right now.
Yeah, I mean, Costco and those other ones are good businesses. They're not good buys or valuations right now. If there was a stock market crash 20, 30, 40%, I would be more interested in them. I want to ask you about how value investing has changed and short selling because you're a hedge fund manager and also you've bought a lot of good undervalued stock picks that have gone up a lot over the years. How much do you think value investing and short selling have changed since the 2008 financial crisis and because of index funds?
Hmm. Well, well, I think first of all, value. What is value investing? That's what we're trying to do, and I don't honestly, I'm not sure that there's much difference between value investing and growth investing. I think if we're fundamental investors, we're all basically doing the same thing. We're trying to buy future free cash flows at the lowest discounted, back to present value at the lowest possible price. That's really all we're trying to do. It's just that growth investors are going to put more weight on future cash flows, and they're going to kind of downplay current cash flows. And I think value investors tend to put more weight on current cash flows and discount future cash flows. Otherwise, I think we're all value investors. So I'm not sure that anything has really changed, and I don't think anything will in that regard. But the trick, of course, is the ability to gauge what the future looks like. And we talked earlier about how I think value investors really got tricked by a lot of these new business models, and they didn't see how current earnings and cash flows had absolutely nothing to do with future cash flows. Absolutely no indication at all. And so, for me, as just trying to adapt and learn some kind of painful lessons when you miss some of these, because they can really help your performance, is I'm trying to pay more attention to companies that are investing heavily today, and it's not showing up. If anything, it's depressing earnings today, but it's going to lead to earnings in the future. I'm just trying to do a better job of valuing those companies.
Are there any specific sectors or industries that you think are doing a lot of the stuff that you just described that are investing in future growth of cash flows and free cash flows that are not getting credit for it right now, like gold miners or copper miners that are putting in the capex right now and the market just doesn't want anything to do with them?
Well, well, that's a good question. Hmm. Yeah, I mean, if those types of companies, they tend to be technology companies. They tend to be software companies where you're going to see really earnings depressed because they've got, they're trying to scale the business, and their sales and marketing expense is very high, and they're expensing that. It's an investment that should be amortized, but they tend to expense it. So all that stuff it shows up in expenses up front, and it depresses earnings. I would say also some of these restaurant businesses, they like some of the fast casual chains, like Kava or Shake Shack. I mean, if you were to look at just a PE ratio, you would, as a value investor, you would not even look any further. You would just stop. You'd say, I'm not going to pay 80 times earnings for these companies. This is ridiculous. But when you look at what they're doing, they're investing, heavily today. I mean, you could have looked at another example from the past, would have been Starbucks in the early days of Starbucks.
Or Chipotle, Mexican Grill. I mean, Chipotle took a lot of
Yeah,
market share over the
yeah,
last 10, 15 years.
yeah. And this is the thing, is that they were investing so heavily up front, and you're really not getting a very good indication of the future cash flows by looking at the current cash flows. So those are those are the types of businesses. I'm not sure I can give you a, oh, aha, this is one area right now where you really ought to be focused on. But just in general, just being aware of this.
I think that's a good point that you're bringing up because I noticed that boots on the ground, not looking at the financials because I know you look at those more than I do for the restaurants. But if you look at like Kava and Sweetgreen, the salad place, and the other one, Shake Shack for burgers, I mean, it looks like they're taking market share away from the established ones like Burger King and Wendy's and McDonald's. That those ones here in the United States and Western countries, those guys are losing market share. People are paying a little bit more money for a higher quality food that's healthier or more options, more flavor.
Yeah, I'm also I'm a big theme investor. So when like retail, I'm a contrarian. I'm a thematic investor, and so retail and even restaurants are well not the fast casual chains. I mean they're the valuations are definitely stretched there, I would say. But retail in general, I mean, is absolutely nobody wants to touch it, and for good reason, actually. But so some of these themes, I always with retail, I always like to have some themes, some tailwinds at my back, and so healthy lifestyles. That's definitely one. Um, I think the migration trends in the United States is another. And then I think the emerging market consumer, that's another trend that I look at. And also the middle class being squeezed. That's pretty much when I'm looking at retail and looking at restaurant chains. So for example, I've recommended Shake Shack. We own a little bit of that, and Shake Shack got into their first restaurant was in Shanghai in 2000. They opened it in 2019, and I think by 2030 they're expecting to have about 55 restaurants, something like that. So Shake Shack is it's a global company. I mean, that's something that definitely interests me. I don't want to have all my eggs in the U.S. basket. I'm very interested in China right now because it's so hated, and so I'm looking for some American companies or Canadian companies that have had success in China. Shake Shack is one of those.
Have you eaten
Yum,
at Shake Shack a lot?
I haven't, but
I've eaten there a few times. The burgers actually remind me of a larger In-N-Out burger from like 20, 25 years ago when I lived in Southern California before the burgers started getting tiny with shrinkflation.
mhm.
They're high quality though.
Yeah, yeah,
You're paying a premium for fresh food and higher quality ingredients.
yeah, and it's translated overseas. That's the bottom line with Shake Shack, and there's, I mean, if you looked at the current earnings, you would lose your lunch. But and I'm not saying that Shake Shack is a cheap stock right now. It's nowhere near the cheapest stock that I have in my portfolio. But there are some things that are getting interesting. Lululemon was another one that I recently added. We're just starting to nibble. I mean, stock is really. I thought I'd never recommend that stock, but Lululemon has been extremely successful in China. So definitely paying attention to companies that are doing North American companies that are doing well in China, and um,
Did you see
uh,
Buffett just started buying shares of what the cosmetic company Ulta Beauty? So he thinks like he doesn't buy that many small caps anymore. In the past, when he was a young adult, when he started as a fund manager, I mean, he used to compound what over 20% annual returns, compound annual growth rate, buying small cap undervalued growth plays. But he just started accumulating a similar business, Ulta Beauty, that sells women's cosmetics.
Yeah, I did see that, and I thought that was very interesting. I have not recommended Ulta, but all of these stocks. What I have noticed is that retailers, the high quality retailers, like Ulta, like Lululemon, they've all been crushed. And I think there there are opportunities there. It's definitely worth a look. You mentioned Buffett, and it's kind of interesting that the Economist. There was an article in the Economist recently, and it was titled "Has Warren Buffett Lost His Touch?" And I think Jesse Spelder actually mentioned this. I think he tweeted about this, and he recalled an article in Barron's in December of 1999, and the title was "What's Wrong with Warren?" Okay, so this is just one of these right interesting parallels when you've seen enough bubbles that you start to see patterns and things and but here's something that's kind of interesting. Grants had a graph of the cash and short-term investments at Berkshire Hathaway as a percentage of total assets. Okay, well, at the top of the 2000 bubble, it was 2%. In Q1 of this year, it was 18%. Near the and lately, of course, they sold a big chunk of their Apple position, and it's now at 25%, which I think is just about the highest it's ever been.
Well, he sold his
So
bank shares too. Not only did he sell Apple, like you said,
yeah,
he's also been liquidating over the last 2 or 3 years. He sold a lot of shares of US Bancorp and Wells Fargo. And then recently, he's been just selling as many shares, I think over $9 billion worth of shares of Bank of America as fast as he can.
well, he's got good reason to because Bank of America has took on a lot of interest rate risk. I mean, that was one. Actually, I own some puts in my fund on Bank of America, and I bought them before I was aware of Buffett selling. But yeah, it's interesting how we get these bubbles, right? And the old hand, the old value investors now, they've lost it. So yeah, it's where we are in the cycle.
I think Buffett understands macro a little bit better than people think he does because I mean he was buying some Japanese stocks a year and a half, 2 years ago. He was buying Japanese commodity trading houses because he figured I think that there would be a weakened yen, so he was trying to take advantage of that. And then he's been I think his largest additions to his portfolio lately, they've been oil and energy companies that he thinks are cheap that can gain market share and growth, like Occidental Petroleum and others.
Well, I don't think you can be completely blind to macro. I don't think that's possible. So, um, yeah, I agree. Yeah, I think it was interesting that Charlie Munger um, got him to invest in China, and but Buffett is. I think they have backed away from China at this point, and of course that's an area that I like. I think it's talk about something that's really hated and cheap and very, in my opinion, misunderstood.
Are,
So,
are there Chinese retail companies that you've been looking at? So are you looking at playing China through commodities or retail companies that sell to the Chinese consumer?
I'm interested in the Chinese consumer. That's my number one. So really, e-commerce. The Alibabas, PDD. We've invested in K-Web, the Crane shares, which has all at Tencent. And there's it's really interesting. I think what's going on. First of all, China, as we know, has been absolutely taken to the woodshed. These stocks have gotten. I mean, they're down what since 2021, 75%, something like that. And some of it was that it was overvalued, like a lot of the stuff was in 2021. But you know, the Western investor, I think there's this narrative about China. It's very black and white. So China is a communist economy, and the U.S. is a capitalist economy, and it's all black and white. And there's no shades of gray that are possibly allowed. And when you look at it, there's all kinds of shades of gray, and in some ways, China is is worse than we are. In some ways, it's better. A lot of ways, it's better. Um, One of the things that I think is a positive, but Western investors see as a negative, is that first of all they had their property infrastructure and property bubble that has clearly burst. Well, they're not just bailing everybody out. And there have been so many calls by Western economists and Western investors that they have to go and do, go back to the GFC playbook in 2008, bring out the howitzer, and so Western investors don't like that. So you have retail investors in China; they're scared to death. They're not buying Chinese stocks.
They're selling. Yeah, they pulled out. Like, did you see in April that there was a record withdrawal of retail investors from the Chinese banking system, cash withdrawals, and that helped cause that spike in gold and silver demand with the prices. I think that's one of the major reasons why we have gold prices here in the West so high is there's a huge amount of metal since October of 2023, the last 9-10 months, that's gone to China and other parts of Asia.
Yeah, yeah, that's certainly that's part of the demand, and I'm not sure how long that will continue, but I do, basically who's buying. So who's buying Chinese stocks at this point? We know that they've gotten absolutely crushed. We know that Chinese retail investors are not buying. We know that investors in the West are not buying. So who's buying? Well, I'll tell you who's buying. Alibaba has a 26 billion. They're sitting on, these companies are sitting on tons of cash, a lot of them. And Alibaba, just as an example, has $26 billion remaining on their buyback, okay, which amounts to about 15% of the market cap. So what's happening is it's a massive transfer of wealth, okay, it's being put in the hands of these Chinese companies. And they're saying, hey, thank you very much. We're going to buy back our stock.
Are they increasing dividends? Are they doing mergers and acquisitions, or are they mostly just buying back the stock then?
Yeah, you have to just look at it on kind of a case by case, and my universe of Chinese stocks that I cover and follow is nowhere near what it is with the U.S. stocks. I probably follow a couple hundred U.S. stocks, and I follow maybe 20 Chinese stocks, and I'm getting better at it. I'm doing more of it, but it's a case by case. But what I am seeing, I'm seeing the buybacks. I think the dividends. I mean, some of these companies actually pay pretty good dividends. You can look at the number one sporting goods retailer in China is Anta Sports. Number two is Li Ning, and it was named after the founder Li Ning, who was the greatest male gymnast in China. And I believe they're buying back stock, and they pay dividends, and they actually pay pretty good dividends. I think Anta pays over a 3% dividend. Li Ning.
Is that, how do you spell the ANTA, Anta?
Yeah, ANTA. The symbol is it's traded on the Hong Kong exchange. It's 2020.hongkong.hk. But these companies are, even though the consumer has definitely pulled back, there's no question about that. And I think from an Austrian standpoint, this is all a good thing because they're basically allowing, not totally, it's not perfect, not a perfect free market in this regard. There's still too much intervention for my taste, but for the most part, they're allowing this to liquidate, and so it means the consumer is going to tighten their belt, and they're going to come out of this much better, much stronger on a solid foundation. That's the way that I'm looking at it. And yet, these companies like Anta are still growing. Li Ning, not as much as Anta. Anta's the leader. Anta's got the better growth, but Anta's also got the bigger valuation. Li Ning, I mean, this thing is so cheap. I haven't recommended it yet, but just to give you an example of how cheap some of the stuff is, I think it trades at less than 9 times earnings. Um, Free cash flow yield is I calculated around 15%, and they've got 54% of their stock prices in net cash. Okay, there's just cash coming out of everywhere you look. So this is what this is what's there if you're willing to put in the work and you're willing to kind of wade into this area that has this big giant black cloud over it, and the narrative, and kind of deal with that narrative. Um,
Yeah,
but
and a lot of the commodity plays too that are associated with like growth in China, those ones have gotten hit too. So like copper, a lot of energy plays, those ones have gotten absolutely whacked as well.
yeah, and so you can look at those as more of a second derivative play on China, but I guess it comes down to a lot of things. What's cheap? Look, I like the energy stocks. I like the commodity stocks. They're definitely um, very much out of favor right now, as everybody has been gravitating towards certain areas like large cap tech. But it's not going to be the same as the boom in demand for commodities that you had with this big giant infrastructure and property bubble. So that's something. But as the middle class, and I'm also not suggesting that the middle class in China is going to expand as rapidly as it did from, let's say, 2000 to 2020. I think those days are probably behind us. But yes, I think there's still at the margin you're going to see increased demand for energy and commodities coming out of China.
Well, I mean, China's still opening about a coal-fired power plant every week or two. They're still doing that. It's just with clean coal now. They put all the scrubbers in. From what I've heard, this is anecdotal. People have told me that like the air pollution in a lot of these major Chinese cities, tier one, tier two, it's a lot better. And so,
Uh,
yeah, they're using coal-fired electricity generation. They just all adapted their coal-fired power plants to clean coal very quickly because they didn't have to go through all the regulatory hurdles, I think, here in the United States.
yeah, yeah, and I'm just looking at the energy bull case as maybe not as much of a demand story as in the past, but still a demand story. I'm a little bit skeptical of all this misdirected spending that will result in energy demand. A little bit skeptical of that, but from a supply standpoint, it's about as good as it gets.
Last question here. I want to ask you about like your coffee can portfolio. Do you put dividend growth plays in there in this environment? If the Fed does panic and cut interest rates back down to zero, people can't earn a quote unquote risk-free rate in their treasuries anymore. Should people be looking to play more defense in this type of macro environment and look for companies, good businesses that can grow their dividends?
Um, well, I'm basically going for where I see the best opportunities. I think I have probably a growth tilt, and yet, so the just to give you, the overall for the coffee can model portfolio, the overall dividend yield of the equities are about 1% on average. Okay, but that's going to be kind of all over the place. It's going to be higher on the energy stocks, but so I'm not necessarily tailoring the portfolio around dividends, but I am looking at the environment that we're going into, and I think it's going to be a difficult environment. And I'm just trying to do certain things to protect us. One is to buy cheap stocks. That's a good way, but I'm trying to gravitate towards companies that are highly profitable, trying to avoid big ticket discretionary items, companies with strong balance sheets, defensive names, that sort of thing. Obviously, we own gold, we own gold mining stocks, and we've got a little bit of portfolio insurance against the triple Qs. So I think we're ready for a tough market, hopefully.
So by big ticket items, you mean someone who would have to use credit card debt or take out an enormous loan at a high interest rate, say to buy a car loan, or something like a super expensive top of the line flat screen television that you're saying that you're avoiding companies that sell stuff like that, like a Best Buy?
Anything that's financed, if it's financed, it's probably not in our portfolio.
Yeah, unless the company can adapt to it. Because I mean, like what these buy now pay. I don't know if you've been watching business television the last month, but it seems like these buy now pay later companies are all doing like the CEOs are all doing like interviews on TV talking about how future growth for that.
Yeah, I don't see it.
Well, temporarily. I mean, it's been going on for the last year or two. But I think it's the younger adults that are doing this buy now, pay later stuff because they don't understand like that they're gonna end up paying way more money for it in the long run with all the financing costs, all the interest payments.
Yeah, it's really a shame. It feels like the kind of the last gasps of trying to, keep up the spending, and obviously there's going to be a payback to all this, and it's really a shame. Yeah, it's a shame because young people, they've got so much to deal with right now. It's tragic.
Do you think short selling is a lot more difficult now, say to scalp like 20%, buying puts or shorting compared to your past in your career?
Short selling has never been easy. There have obviously been good times, better times to do it than others. I think that to wow, I mean, to be a good short seller, um, one of the things is I think you have to be able to find situations where there is a potential for the stock to go to zero, for the business to be impaired. Um, I think one of the huge mistakes to make with short selling is to try to short something based on valuation. So that is, if I'm looking at things, unless the valuation is absolutely insane, and it has to be a big number. Okay, it's the law of large numbers. So um, I would not have a problem with, let's say, shorting stocks with $1 trillion valuations, because I don't think they're to go from, let's put it this way, to go from a $10 billion valuation to a $50 billion, or let's say a $20 billion valuation, that can happen very easily. But to go from a $3 trillion valuation on an Nvidia or an Apple to a $6 trillion valuation, I just don't. I know that it's happened very rapidly, but to get that next 3 trillion, get a double from here, really tough. So it's all about risk and reward, and I think so one is you've got to, as a short seller, try to find things that can go to zero. We had a real garbage market back in 2021 with these meme stocks flying. So that
And the
was
SPACs,
really,
yeah, the SPACs
yeah.
too. They dumped all those onto.
So that was a really rich environment for short selling. Of course, the short sellers were all wiped out by then. Nobody took advantage of it. Um, this time it's a little bit different. Those stocks have all been kind of they've had the juice kind of taken out of them. It's nowhere near as ripe an environment for that sort of thing. I think what we're doing is we're using puts, we're using bear funds, and we're trying to hedge with the Mag 7. I'm looking at the Mag 7. I think the problem is they're they're businesses that you're not going to be able to kill. They're not going to zero. They're basically at this point they're valuation shorts, and I think they're going to. If I'm looking at the next 10 years, I think they underperform an active approach to investing. So they're probably just a no touch at this point. And I think also longer term, again, this comes down to kind of risk and reward. It's bonds, because bonds can only go so far, and they can only rally so much. I mean, yields can only basically go to zero. Um, and so I think U.S. government bonds are a long-term short. I wouldn't have a problem as a short seller, maybe targeting that. But yeah, shorting is tough business. And you know what? I'll also add this, Jason, that right now, one of the things, and I think this is kind of counterintuitive, when you're in a bubble, bubbles also spawn anti-bubbles, and those anti-bubbles often are the best opportunities that you're ever going to get on the long side. So I just see that there's a lot of opportunity there, and so I'd rather focus most of my attention on the long side, and on the short side, the things that are excessive you can avoid. Maybe if you want to take a stab at the banks or Apple or Nvidia, it might be worth it on the short side.
It also seems that like if a company, especially a large company like Nvidia that pays a fine only like 2 or 3 years ago for accounting fraud for the misstating and paying a SEC fine for saying that they were claiming that a small percentage of their earnings were based on selling those graphic cards for Ethereum mining or crypto mining. In reality, it was a lot worse than that. And then they paid a fine. It seems that the market and the regulators don't really care about accounting fraud too much anymore. Maybe if it's a small company, but the large companies just pay a fine and then the shares are fine. No one goes to prison or anything.
Well, look, I don't know about that. It sounds to me like it's small potatoes in the big scheme of things. Um, the reality is Nvidia has a huge lead. They've got a tremendous demand. They're the only game in town. They're printing money right now. Um, it's not an accounting fraud. Um, and so I don't think I'd want to look.
Well, I didn't say
There
the
are
whole thing is
accounting
accounting
frauds.
fraud. I didn't say the whole thing's an accounting fraud. I
No,
just said that
I
like,
know,
they're
but
padding their earnings. They were playing games like in the past though.
yeah, but and maybe that's a part of the bubble. Um, but I think you just have to differentiate if you're a short seller. And let's face it, not many people are really cut out to be a short seller. And I'm going to raise my hand and say I'm one of them. Um, it is really tough to be a short seller. I think either you have to be really good at sniffing out frauds, and not too many people are good at that. And I think there are probably, well, in this kind of bubble environment, you may see some more of those, but I don't think there are as many of those as there used to be in the past. And then the other area, like I said, you could short government bonds. I wouldn't short them right now because I think they'll probably rally as we go into a recession. Or you short or maybe use bear funds or put options on these mega tech stocks where the risk reward, because of the valuations pushing $2-3 trillion, they can't really go much higher, and you've got your downside protected. I think that's how I would look at it.
Okay, so you're talking about scalping then, like you said a couple of minutes ago, those large mega Mag 7 big tech companies, they're not going to fail, but the shares could drop 20% or 25%. They could be in a small bear market then for a certain amount of time.
I don't know. Honestly, I think that first of all, I wouldn't short anything if I thought it was only going down 20%, 20 or 25%. I would never even think about it. I'm looking at it more of a hedge with what I've already got. And, it's pretty obvious that there's a bubble. First of all, I think that, there is this definite gold rush into infrastructure for generative AI. The leader obviously is NVIDIA. They have a moat, they have a big lead, but all moats can be bridged and crossed at some point. And demand, it's not just competitors, but it's also the demand side. So I think that NVIDIA and Apple, I'd put Apple into this category as well. I think it's pretty easy to see those stocks going down 50% or more. Are they going to go down 99%? No, that's not going. So you just have to understand what it is that you're dealing with. And as a short seller, I would the ideal situation would be, a garbage company like AMC Entertainment that gets caught up into this crazy bubble, where that this thing can go. It's got a lousy business. It's got a crazy valuation. It's gone straight up, and all of the novices have jumped in for really kind of bizarre reasons. They don't even care if they lose. They seem to not care if they lose money. I mean, it was really nuts. Um, that you have an edge in that game, and if you're choosing to be a short seller, those are the types of opportunities to they don't come along very often. But the bottom line, Jason, is it's risk reward. What's your reward for shorting a stock? Um, I'd rather try to find stocks that I think could be 10 baggers or 100 baggers if I'm going to hold them for 10, 20, 30 years. And, I think with some of these anti-bubbles, some of those stocks are out there.
I agree. It's easier to look for businesses with a product or service or companies, even if the gold companies, for an example, at the current price. I mean, if the gold price doesn't crash, if the gold price stays at 2,500 for a while or even goes higher, some of these companies are going to mint money. Yeah, their costs might go up, but maybe they'll figure out how to lower costs or they'll go buy a better project. Especially if they're a royalty company, there's going to be new gold mines and copper mines that get financed at these prices. And those are additional like call optionality for the royalty companies that the market wasn't projecting. So those are like royalties on land packages that are going to get the funding at 2,500 gold. They're going to restart a mine. They're going to build a new mine. And those are going to be additional cash flows for the royalty companies going forward that the market wasn't accounting for. And that's how you get what valuation multiple re-ratings and higher multiple and growth and dividend growth and all those good things.
Yeah, no, I agree. We love the gold stocks, and I think they are a hedge against monetary mismanagement. We know that that's what we've seen, and we know that these things are likely to get a lot worse. So you look at. I think as an investor, when you're building a portfolio, you're trying to survive multiple environments. You have to survive all environments. You have to imagine as many different environments as you can and build a portfolio that maybe is not optimized for any one environment, but can survive all environments. And then you tweak it as you go through these environments. So, I think it's important to do some hedging. And, we talked about short selling. Short selling is dangerous in an environment where the Fed is printing money. So what's your hedge? Well, maybe your hedge is to own some precious metals. Maybe your hedge is to own some gold stocks right now. Another thing is in terms of a portfolio diversifier, bonds have traditionally been that diversifier. Bonds work very well in the GFC in 2008. They didn't work so well in 2022, and they may work a little bit better if we go into, and I think we will go into a recession. But at some point, I don't think bonds work as a portfolio diversifier. And so, guess what? Investors are going to need that, and they're going to be at the margin going to be putting more money into, I think, gold and probably gold stocks. So, it's like all the stars are lined up for gold, and gold has obviously had the first move. The gold stocks, because Western investors account for a lot more of the demand, and they've been more interested in Nvidia and Apple and that sort of thing. They have not been paying as much attention. And gold stocks should be doing backflips right now, and they're not. So it's a great opportunity. You even look at China. We talked about the China retail investor, and obviously they buy gold, but traditionally they have not bought gold stocks. Well, China is starting to come out with ETFs, funds that invest in gold stocks. So there's all kinds of potential for that demand, not just in the U.S. but around the world, to kind of pick up and catch up. So yeah, lots of tailwinds for gold and gold stocks.
Yeah, as long as metals prices don't crash. So it looks like demand is very strong from non-G7 central banks. It's the dollar cost averaging each month has picked up each month since the Russia sanctions in early 2022. And the Asian demand for physical gold and physical silver has been absolutely enormous since October of 2023. A lot of these Asian countries, the retail investor, China, India, Japan, Korea, Thailand, Vietnam. The demand is exploding. I've never seen anything like it. I guess they're hedging currency debasement, fiat currency debasement here from monetary inflation from governments and central banks.
Absolutely. Fred Hickey just came out with his newsletter, and he talked about the central bank of Poland, and Poland has been buying gold, and I think he said that they're going to be taking up their reserves to something like 20 or 25%. I mean, that's starting to get close to a gold standard. So, yeah, it's really fascinating to watch this all play out. And I think part of this too is that the U.S. Hegemony. You had when the Soviet Union collapsed. Basically, it was all U.S. and I think those days are pretty much coming to an end. And I think a lot of countries around the world are realizing this and starting to compete with the dollar in terms of a reserve currency. So I'm not saying that's going to end, that status will end overnight, but it's starting to be challenged. And I think this is another reason, another example of how it's not so black and white with U.S. and China. China is acting, their central bank is acting more responsibly than our central bank. I don't think there's much question about that. And there are a lot of central banks are acting more responsibly than ours.
Well, I don't trust any of these central banks. They all figure out bailouts or rule schemes or funnel money to their friends in government or the large corporations. There's just too much corruption with in general with all these governments right now and money printing. I mean, during the pandemic, it was all these governments were doing insane amounts of bailouts and liquidity programs and money printing. I think many trillions of dollars was created between 2020 and 2022, and it wasn't just the United States.
Well, and look, I don't trust any government or any central bank either. But as investors, we do have to kind of handicap, what is expected in prices and what is likely to happen. And right now the expectations are clearly very high in the U.S. and they're extremely low in China. And so, I think China. All I'm saying is there's a disconnect. We're not as good as. I think Grant put out a piece, and it said that the U.S. market cap in the MSCI was 72% of the world total. I'm not sure what China is, but it's got to be tiny. And all I'm saying is, if I'm looking out 10 or 20 years, U.S. is not going to be at 72% 10 or 20 years from now, and China is not going to be whatever it is, 5 or 10, whatever, probably 5%. That's going to change.
I want to thank you so much for your time today, Kevin. If my listeners want to check out your work with the Coffee Can portfolio, how did they do so?
Yeah, all they have to do is go to my website. It's thecoffeecanportfolio.com. And they can also follow me on Twitter. I don't post as much on Twitter anymore, but my handle on Twitter is at Kevin Duffy 1929.
Excellent. Well, I look forward to our next conversation.
Likewise. Thanks for having me on, Jason.